Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hello there. Welcome to the show today. So if you've been earning money or investing for any length of time, you know that old Uncle Sam wants his cut. Ugh. At first, trying to figure out the tax effects of various types of investments can be a little bit mind-boggling. The investment choices you make, like stocks, bonds, ETFs, mutual funds, real estate, crypto, all that stuff, all have different tax structures. Way to make it easy, IRS. On top of that, the account where you hold your assets, like a traditional IRA, a Roth IRA, 401k, or just a brokerage, also factors into your tax liability. Although this seems complicated, tax liability boils down to two questions. When do you owe taxes on your investments, and you will owe? And how is the tax on the investment structured? Do you pay capital gains tax or ordinary income tax? Given these two questions, we've simplified the tax implications of various types of investments. So with today's guide, you can start to understand how taxes will hit your overall portfolio. Let's first talk about tax implications of a brokerage account. So a brokerage account is an investment account that has no special tax rules. If you only invest in retirement accounts, you may not have a brokerage account right now. However, if you're investing for goals outside of retirement, it may make sense to open an online account at a low-cost brokerage. Assets in a brokerage account. Typically, brokerage accounts hold cash, bonds, stocks, ETFs, mutual funds, publicly traded real estate investment trusts or REITs, options, and other financial assets. Sometimes these accounts even hold cryptocurrency. Crypto taxes addressed in just a little bit. What types of taxes will you pay on assets in your brokerage account? You're going to pay some capital gains taxes when you sell or even trade assets in your brokerage account. You'll pay capital gains taxes every single year that you sell assets for a profit. If you traded in the past year, you can expect to receive a 1099-B tax form from your brokerage. Most assets inside a brokerage also produce dividend income. If you earn income from your investments, your brokerage will also provide a 1099 div at tax time. Dividends and other types of investment income are taxed as ordinary income, which is typically a higher rate than capital gains taxes. Are there penalties for withdrawing money? This is a big question. And no. You will pay capital gains taxes on assets and ordinary income tax on dividends. You're not going to pay penalties if you withdraw money from your brokerage account. When will you expect to pay taxes? Okay, so when you have assets in a brokerage, you should expect to pay some amount of taxes every year. If you sell assets frequently, you may pay more in capital gains taxes. But don't make the classic investing mistake of holding on to avoid taxes. If you've got a stock that doesn't fit in your portfolio, just start selling it, even if you incur some taxes. After all, you'll only pay taxes if you've made a profit. Now let's talk about some of the different types of common accounts and the tax implications of those. First up, a traditional IRA. A traditional individual retirement account, or IRA, is an account that allows people to invest for their retirement. If you put money into a traditional IRA, you may get to take a tax deduction in the amount you invest. Your ability to take a deduction depends on your income. In 2022, you can contribute a maximum of $6,000. For example, if you invest $6,000 this year, you can take a $6,000 deduction. However, you must pay ordinary income tax rates when you withdraw money during retirement. When you hit age 70 and a half, you have to take distributions. Have to. It's called a required minimum distribution. Let's talk about assets in a traditional IRA. Most people hold cash, bonds, stocks, ETFs, and mutual funds in their traditional IRA. Sometimes these accounts hold alternative investments like real estate, crypto, or some other assets. So let's talk about what types of taxes you're going to pay on assets in your traditional IRA. You may qualify to take a deduction when you contribute to a traditional, up to the annual limit, which is currently $6,000. Each year, you'll receive an IRS Form 5498 that shows your contributions. Great tax software is going to help you calculate whether you're eligible to take the deduction. When it comes to paying taxes, you're going to pay ordinary income tax on the amount you withdraw. The brokerage housing your account will provide a 1099-R when you make withdrawals. You have to start taking withdrawals at age 70 and a half. Are there any penalties for withdrawing money? Yes, you'll pay a 10% penalty if you withdraw money before age 59 and a half. When will you expect to pay the taxes? Investments inside a traditional IRA grow tax-free, even if you buy and sell assets. You'll pay ordinary income on all money you withdraw from the account. The amount you withdraw is added to your ordinary income for the year. Now we look at 401k and its tax implications. Very similar to the traditional. A 401k is a workplace retirement savings plan. For the most part, a 401k has the same tax rules as a traditional IRA. You get a tax break today, and your investments grow tax-free until you withdraw the money. At that point, you'll pay ordinary income tax, and, just like a traditional IRA, you have to start taking 401k distributions at age 70 and a half. Some workplaces offer a Roth 401k. Those plans follow the same rules as the Roth IRA. And we talk about that in just a few minutes. Let's talk about assets in a 401k. Most companies do offer ETFs or even mutual funds inside their workplace 401k. A few people with self-directed 401k plans may be able to invest in single stocks, real estate, or other alternative assets through the plan. What types of taxes will you pay on assets in your 401k? Contributions to your 401k show up on your W-2. As an employee, you can deduct all the money you contributed to the plan. If you're self-employed, you can deduct your employee and employer contributions to the plan, but you'll need to track this on your own. When it comes to paying taxes, you will pay ordinary income tax on the amount you withdraw. The brokerage housing your account will provide a 1099-R when you take withdrawals. You have to start taking withdrawals by age 70 and a half. Are there any special rules for individual 401ks? If you're self-employed like me and you have more than $250,000 in your account, you need to file a Form 5500-EZ every year. This form gives the IRS visibility to your account. Are there penalties for withdrawing money? Yep. You're going to pay a 10% penalty if you withdraw money before age 59 and a half. But if you're between 55 and 59 and a half, you can avoid the early withdrawal penalty if you withdraw money from your current 401k. You may also avoid penalties if you set up a self-funded pension called substantially equal periodic payments. Which begs the question, when will you expect to pay the taxes? You will only pay taxes when you withdraw money from your 401k. Now, that leads us to the Roth IRA, which is kind of the inverse of a traditional IRA. You actually pay taxes on your contributions, but the account grows tax-free. When you withdraw money during retirement, the withdrawals are tax-free. Annual Roth contributions are subject to income and contribution limits. As a bonus, you can withdraw your contributions without penalty at any time. Let's talk about assets in a Roth. Most people hold cash, bonds, stocks, ETFs, mutual funds in their Roth IRA. You might hold alternative investments, of course, like crypto, some precious metals, or real estate in your Roth account. What types of taxes will you pay on your assets? If you contribute to a Roth IRA, you won't qualify for an immediate tax deduction, but the account does grow tax-free and withdrawals are tax-free after age 59 and a half. Are there penalties? You will pay a 10% penalty if you withdraw money before age 59 and a half. When will you pay taxes? You're going to receive a Form 1099-R when you take money out of a Roth IRA, but the withdrawals typically won't be taxed because your contributions are post-tax. Let's move on to crypto investments. So most people who own crypto, like Bitcoin, own it inside of a brokerage account, but crypto investing feels just a little bit different than other types of investing. For example, you might be surprised that crypto-to-crypto trades are actually taxable events. The IRS treats crypto investing just like stock investing. You're going to pay taxes when you trade crypto assets or when you earn income through lending or staking. We have a detailed guide that gives some further details on crypto taxes at thecollegeinvestor.com. But here are some highlights. Assets in a crypto account. Okay, so whether you hold your crypto in a hardware or software wallet, most people buy and sell crypto through a crypto exchange like Coinbase. You probably own stable coins, which are pegged to the US dollar or other currency, and crypto. What types of taxes do you pay on crypto? If you trade crypto, you'll pay capital gains taxes whenever you make a profit. Most people need to use a tax calculator to figure out their tax liability from trading crypto. A crypto tax calculator will generate IRS Form 8949 for users. You can upload this form to TurboTax or TaxAct to figure out your tax liability. If you earned income from crypto, like through staking, you may receive a 1099 miss from your brokerage. Otherwise, you need a report from a crypto tax calculator to show how much you earned. Are there penalties for withdrawing money? Nope. There are no penalties for withdrawing crypto. When will you expect to pay the taxes? You're going to expect to pay taxes on crypto every year that you trade or earn money through staking. Now, we move on to real estate and the tax implications there. So whether you're a house hacker renting out a room, a multifamily investor, or maybe just someone slinging rooms on Airbnb, you need to understand the tax implications of rental real estate. As an investor, you may have hired someone to keep the books for your rental portfolio, but most likely, you keep track of profit and loss by yourself. Because there are no official forms, you need to stay on top of the tax liabilities by yourself as well. If you're participating in crowd-funded real estate, the tax implications are just a little bit easier. The company managing your investment will send you the necessary forms at tax time. Easy peasy. Let's talk about types of rental real estate. Real estate investments range from short-term rentals, think Airbnb or Vrbo, multifamily investments, and house hacking in your primary residence. Crowd-funded real estate investments may include real estate syndications and privately held REITs. What types of taxes will you pay on this rental real estate? You're going to pay ordinary income on rental income you earn. Of course, you can deduct legitimate rental-related expenses when calculating your income for the year. All rental income is reported on Schedule E on your taxes. If you're not sure how to properly report rental income, by the way, we recommend an easy-to-use tax filing software like TurboTax. They're going to do the heavy lifting for you. If you invest through crowdfunding sites, you'll learn more about your rental income through IRS Form K-1. This gets copied to the Schedule E. Form K-1 also reports information about capital gains and losses from the business. In some cases, you might receive a 1099 div or 1099 INT. Income on these forms is taxed as ordinary income, and it appears on Schedule D. If you sell an investment property or your primary house, you have to pay taxes on the gains you make. Up to $250,000 of capital gains are shielded when you sell your primary house. Are there penalties for withdrawing? No. You can choose to spend your rental income, or you can reinvest it. Are there special tax advantages of house hacking? If you rent out part of your house, you might qualify to deduct a portion of your property taxes, insurance, and utilities in your Schedule E. If you sell your primary residence, the first $250,000 of capital gains are not subject to taxation. $500,000 for a married couple. This is one of the only ways to earn tax-free money. When will you pay taxes on this rental income? Every year. You'll only incur capital gains when you sell a property. If you're managing your real estate finances, keep clean records so you can easily calculate your taxes each year. Now let's talk about peer-to-peer lending. This is interesting. Online peer-to-peer or P2P lending platforms like Prosper have made it relatively easy to earn money by just lending it to other people. If you're investing in this space, you'll receive several investment forms that are otherwise fairly uncommon. What types of taxes will you pay on this P2P lending? Interest from P2P lending is taxed at ordinary income tax rates. You'll receive a form called 1099 OID from your online lending platform. This form indicates that the income you earned will be on Schedule B with other interest and dividend income. If a loan fails, the losses will be reported on Form 1099-B. Capital losses do count as a deduction against your income. Are there penalties for withdrawing any money? Nope. You can choose to spend your P2P loan money or just reinvest it. When will you expect to pay the taxes? You're going to pay taxes on P2P loan interest every single year. That was a little bit of a mouthful today, but I hope it was helpful and provided a lot of useful information for you. And we also invite you to share this with a friend or family member and maybe encourage them too and help them along as well. You can follow us. We're all over social media. Just search for The College Investor and you'll find us. We'd love to get to know you too. And check out thecollegeinvestor.com if you want to dive deeper and find out more about all things taxes and investing and crypto and more. It's all there at thecollegeinvestor.com. Thanks again for stopping by today. We'll talk to you again real soon.